Good morning, everybody. It is Tuesday, June 2nd, and we are in the midst of a choppy market that keeps inching out gains, but maybe not for much longer. So let's take a look at what's going on. This is an updated presentation that will be available later today at both services, so margin of safety as well as fundamental trends. And I'm going to make this webinar public. Our general thesis: cascading economic destruction this year with a lot of policy response. Next year, lingering economic weakness with some inflationary policy that could create stagflation. I actually think we're much closer to this. I'd say we're seeing stagflation almost a little bit right now because of food prices rising, and we'll see what happens later in the year, particularly if there is a catalyst for the price of oil to break 40. 2022, the economy should start to recover. Presumably that coincides with a vaccine for coronavirus that is widely available and distributed. As of right now, we haven't bet the curve. Talked about this on Friday. Deaths have started to tick up. I haven't seen the last couple of days, so hopefully this number has come back down. The reproduction rate unfortunately bottomed a few weeks ago, has been rising again to a shade over 1. We need this number down by 0.5, and we were on our way until we decided, oh my gosh, I need my freedom. Data suggests, and this is CDC data, so President Trump's data, that coronavirus deaths are vastly undercounted. We're getting a lot of narrative that vaccines and treatments are right around the corner, yet the professionals tell us that's not true. Moderna, with an approach that's never really ever been approved for anything before, seems to be the darling right now, but they issued shares and then the executives took profits. It'll probably be one of these up here. Or several of these that get approved. Anything that messes with your RNA or your DNA, you should really think about. Really think about. So what should we think about this? We should know that we're not going to get a V-shaped recovery. I've been in the U-shaped recovery camp, and Jeff Miller, who him and I keep in touch a little bit, he thinks we're going to get a W. And I think that could be some validity to that. The W, that middle bump up in the economy, would be very small though. It wouldn't be a giant, recovery followed by a big crash. It would be a little recovery, setback, and then a correction, or then a revival. So the W shape, the U shape, I think they're similar. Think of the U with a little bump in the middle, which I think we're seeing this summer. And we'll see this summer. People are going to try to at least get out. I don't know if that means that a lot of places are filled indoors, but I think outdoor venues do all right. And open air places to shop, outdoor malls, strip malls, I think will do okay. That's why we own Store Capital. But a lot of the economy is still in rough shape. And we are seeing on assembly lines and in food production that because of the close quarters, they are having problems staying open. Ford had to have a shutdown. We'll see what happens over at Tesla and GM. We're seeing all sorts of food disruptions as well. That's the thing that I'm most worried about. Unemployment, we know all about the spike. We know that unemployment or that employment has actually been tailing off for over a year, actually about 2 years. So while this was tipping over, let's really pay attention that we were really not in a great position even before coronavirus. Average weekly hours worked in manufacturing fell dramatically. We're seeing, this is what I call a shake and bake recession. When I was a kid, I've told you this story before. A lot of folks in my family and friend groups and their friend groups lost jobs during the Ronald Reagan recession, and this seems to have a lot of that going on, except it's not going to hit manufacturing quite as hard because of the deglobalization going on in supply chains. So as supply chains move closer to customers, there's an offset, but manufacturing definitely has been hit. We know that new orders are down. We know that there's a lot of places closed, but really it's the service industries, those middle to low end jobs that are getting crushed. Um, and maybe we see some of that frustration coupled into the protests that we've been seeing for the last several days with regard to the George Floyd deaths. I've talked about for years that at some point, financial frustration and instability and the mental health issues that come with that, and it's just the constant frustration, a match could come along and light that. And I think to an extent we're seeing that. Although I would be remiss not to mention that I have been keeping very close track of the protests through people all over the country. And we know that about 80%, give or take, of the protesters are, just trying to make a point and being generally peaceful. You've got that 20%, and again, these are fudgeable, but I think the 80-20 rule applies roughly in most things. You got that 20% of people who are shitheads. So if you saw my tweet this weekend, yeah, America suffers from an 80-20 problem. 20% of the people are just flat out shitheads, and it doesn't matter if you're black or white, Democrat or Republican, there's just a lot of shitheads out there. So, that's probably where most of the violence is coming from. And, some of the videos that we saw clearly were agitators. So it's hard to know who's who under those masks. Federal Reserve seems to be the only thing holding up the asset markets right now. And that is clearly not something that can be permanent. Even in the last 12 years, we've seen mini corrections, and then we had the blow off at the end of 2018. The repo market had to be bailed out in the last half of 2019 and early into 2020, and then coronavirus hit. So what would make people think that coronavirus isn't going to exacerbate the problems that we already had in the repo market, where financial institutions were basically teetering on the edge of insolvency? That's what was going on in the repo market. We talked about that this fall. So do we believe that banks, particularly banks that take leverage that is excessive, to try to turn a trading profit, how are they going to do in all of this? Somebody's got to be on the wrong side of the trade, right? And it's not a zero-sum game when you have all of the derivatives that are involved. The credit default swaps have to have a counterparty that can pay. So if counterparties can't pay, that means that even the person on the winning side of the trade didn't quite win. we looked at all this stuff on Friday, so part of this report is regurgitated, but I wanted to do a brief summary at the start here. So the indicators in the stock market indicate that the stock market is topping again, but the high money market assets and low margin mean it could rally more. Now, I do have a contrarian view on the money market assets because I don't think it's the middle class that's suddenly being out of work has assets to throw in the money markets. That's not who is accumulating cash. So the market is where you are. The AAII survey shows neutrality. The survey shows neutrality, but the equity put to call ratio shows that euphoria is setting in again. And just because we reach these points down here doesn't mean that we can't jitterbug around for a little while, meaning that the market could go up a little bit more. Short interest ratio is plunging, and it's very low. It could go lower. We see that start of 2018, the short interest ratio was very low. We had those two corrections. So again, nothing, when you see an indicator, it doesn't mean that something's going to happen the next day. There's generally a time delay. Some indicators are more on the mark, within a week. Other indicators are basically just saying, hey, you're on thin ice, and anything could crack that ice. So, at the end of 2018, we had a lot of people get out of their short positions, and the markets kept going down. But then the short interest ratio came down and down and down and down, got a little correction in the middle of last year, that choppy period. And now we have very low short interest again. Again, I believe that's because people think that the Fed can keep things going forever and that they have a motivation to do so. I would throw this scenario out. I don't know the Fed Chairman Powell is really in love with President Trump. But I also know that he's a Republican. At some point, whether it's before the election or after the election, Powell has to try to at least partially normalize again, or move away from the direction of extreme policy response. When does that happen? You need to consider your risk appetite for the possibility that that could happen again at some point. Margin debt's neutral right now. The NASDAQ NYSE volume hit euphoric. Retail money market funds. I want to point out, I told you in early 2018 and throughout this period, I get questioned all the time. Why do I think that the family offices and the wealthy have been net sellers? It's pretty easy to follow. All you have to do is take a look at the family office survey in Institutional Investor magazine. You can also follow Yardeni, who puts out and has been putting out statistics for 40 years. The super wealthy have been accumulating cash, selling appreciated assets, and remember, many of their assets are illiquid, meaning real estate and businesses and things like that you can't just go into the stock market and trade like that. These are assets that require a legal transaction, and that takes time. So if they're selling buildings or businesses, you wouldn't expect it to be all at once. It's a process. So starting in 2018, that process began to start unwinding investments in appreciated businesses and real estate so they could get the low capital gains rates that President Trump and the Republican Congress passed. So this, what you see right here, is a liquidation of appreciated assets. That's really what that is. And then part of this is the Fed printing money. So this is all money, $400 billion, that is essentially in the hands of the wealthy. This is not middle class money. Why isn't it invested? So I don't think that this is the greatest, oh, look at all the money on the sidelines. Sure, when do they come in and buy? I don't know. Let's ask Warren Buffett. Why hasn't Warren Buffett come in and bought yet? It's because the economy is that weak. I've told you I don't think there's a recovery really coming until 2022. That's 2 years from now. The CBO, I believe, and I saw this earlier and somebody mentioned it, that said that the economy is going to take many years to recover, possibly to the end of the decade. Now, that would coincide with my boom that I'm talking about. I do think there will be massive stimulus next year, and it's going to blow your mind, the projects that we're going to do. The only thing that could prevent that from happening is if Joe Biden wusses out. At this point, I might as well throw out there that I again got private polling data on the election. President Trump is like 15 million votes behind. We're talking an epic land scale, down ticket impacting election result coming in November. Take a look at all these folks in the streets. There's going to be marches to the voting booth. If President Trump gets 60 million votes, I'd be shocked. And I think he's going to be closer to 55 million. And Biden is going to be around 70 million votes. There is no path to an electoral college victory if that is the spread on the popular vote. And in fact, if Biden just gets what Hillary Clinton got, Trump can only afford to lose about 1 million votes. And he still has to eke out all the states that he eked out. He's not going to get that many votes. It's impossible. There aren't new voters out there for him, and he's losing part of the Republican Party. So, yeah, this isn't even going to be close. I'm telling you, Trump's going to get blown out. And you better wrap your head around how that impacts things. And I will tell you, it's probably positive. I was talking to a client yesterday. If President Trump wins, which, you got to put a single-digit percentage on. I don't know if it's 1% or 9%, but it's in there. And I'm a gambler, and I'm an odds guy, and I'm a Bayesian math guy. I do believe that we get a depression that did end up with the military in the streets. So, take that into account for what it's worth. And I will show you in a minute that I'm not the only one thinking this way. In fact, I will show you right now. Nouriel Roubini is saying the exact same things that I've been saying for years. That the underlying financial frustration of a significant majority of the population is coming to a head. And the George Floyd murder, because that's what it was, is just a match that lit this. And when the protesters see police in certain places becoming very abusive versus what they did in Flint, Michigan, and in Milwaukee and other places where the cops actually took a knee or stood back and let people do what they wanted to do, it just protected the buildings, basically. People have a reaction. So I believe that what you're seeing right now is not going to die down anytime soon. I think this is going to be like Hong Kong. I think that we're going to see perpetual demonstrations through the election. And I think that it's going to have a significant impact on a lot of things, including probably the transmission of coronavirus. So I don't know exactly how this road wobbles, how it winds, where the potholes are. But I'm not comfortable being a particularly long investor right now. I believe that the risk of a 20% correction is almost a certainty. And I think 30 and 40% are probably likely. And the Armageddon scenario that I described, one of the three scenarios, new bull market, retest the lows, or Armageddon stock market, something like a 60, 70% drop, unfortunately has grown. Getting a little dry throat there. So I think that folks have to take a step back, put your ideology aside, and stop assigning blame. And maybe just, if you're going to blame, do it the way I do, which is the buck stops at right at the top. So I've laid out situations where I thought we could see dramatic improvement in communication and policy from the top. It hasn't happened. Rather, we're getting threatened with the military. And I think that that is not indicative of an economy that's about to boom, or a stock market that can, keep withstanding the reality of the day. Put to call ratio, anytime it gets down to around 50, you see a recession, or a correction. Had this period here led to, we were going to get a correction anyway. I told you all throughout this period we were going to get a correction. Now, would it have been as bad as it got? I think it probably would have been. In fact, I think had the Fed not intervened so strongly, we would have gotten that Armageddon crash. And again, ask yourself why Warren Buffett didn't invest down here. Why did he accumulate cash on the way down and not redeploy it? He's got investment generals there that can help him. They could have said, these are the great ideas, and he said, no. Man, I'm telling you, if Buffett is scared, you should be scared too. And once again, we have the equity to put ratio way down. And I would suggest that this period here, and I probably should have put a little red 9 connecting those, is indicative of some of these other periods where, like right here, where for a couple of months, right before the first 2018 correction, we had to put the calls very low. Put the calls very low. Put the calls very low. Now, can this chop around for a little while? Certainly. It doesn't mean that the correction starts today or tomorrow. But it does mean that unless there is some wall of worry to climb, indicative of more puts before a correction, right? Puts before a correction typically are bad puts. But puts during a correction are just people chasing the correction. There's very few people who ever short the market correctly. That's why when somebody gets rich doing it, like a couple dozen people did in 2008, they become legends. Why? Because out of millions and millions of investors, a few dozen people got it right. So that's why I'm not terribly aggressive with my shorting, because it's very hard to do and it requires perfect timing that's usually accidental. There's no technical indicator that will be perfect for you. Not MACD, not RSI, not quant factors, nothing. Because things can change overnight. In the space of 4 to 8 hours, the stock market can completely flip over now. Between the high frequency traders, all the day traders that trade off market hours, right? We know that around 90% of the change in price in the stock market happens overnight. There's almost no change, net change in the stock market price during the day. Everybody who's anybody understands that you front run the market. If you're a trader, if you're a day trader, you front run the market overnight. That's how you do it. So when I tell you, hey, if you're going to trade at the very end of the day, what I'm telling you is you're looking for a counter trend move for the next day. So if you have a strong market all day, and then it drops at the very end of the day, typically there will be some continuation early in the morning, and then it'll turn around. So you can do those counter trend trades, right? You see the trend change at the end of the day, just generally follow through the next day, but then it goes on its merry way later on. And because we know that the bias is to have no net change, you can just play the range. What you really need to do if you're a long-term investor, or even a swing trade investor, is you need to look for these extremes that happen from time to time. So in a bull market, you buy the dip. In a bear market, you sell the rally. And that's where we are right now. We're in a bear market. Anybody who thinks different, who thinks that we're in that new bull market scenario, then you're just going to have to do things differently than what I'm telling you. But if you believe that the economy is going to have a V-shaped recovery, and that this stock market can just keep going up and up and up, I think you're sadly mistaken. I'll take my side of the bet against you, and good luck. I'm not going to say I hope I'm wrong, because I'm doing what I'm doing. But I think you're taking extremely high risk to be more than a little bit long right now. I've told you that I'm net neutral. I'm net neutral to about negative 20% in the market. At about negative 20% in the market, I'd probably start losing a little bit of money too, because I'm not terribly hedged, and I have all those covered calls written. So once the stock market got to the point where my covered call premium was basically gone, and the stock started to fall through the premium I had collected, I can start losing money too. I won't really lose much the first 20% down. I do have those few SPY and IWM puts right now that would help me mitigate my losses once it dropped about 20%. But I'm not outright speculating on the stock market crashing right now, because we do have some ambiguous signals, and the Fed is printing money, even though it's really bond market money. People believe what they want to believe, usually out of ignorance, and that can go on for a while. We know that the stock market can be irrational for longer than a short can be solvent. So let's take a look at these combined total short positions that the other chart had. Notice that when the combined short positions are low, you either get a choppy period or you get a correction. So right now, the short positions are falling. And as they get basically under this line, which you're about to do, we've already gotten some chop, but the market's trying to push higher to these other resistance levels. It could go up to around 320, 325, could. We'll see if it does. I don't know, just like VIX has reset at a higher level, I'm not sure that this will come all the way down into here. The market is here to fool you. So this might be as low as it goes in this area here. Breadth. People talk about the breadth of the market all the time. And they say, well, the market's being led by just a couple of stocks. Right? That's bad. Well, kinda. When breadth gets very low, what does that mean? That means that a lot of stocks will gradually participate as the rally spreads. And that's what's happened in the last couple of weeks. Breadth has gotten extremely high. When you get towards 80, doink, you usually get a correction that follows at some point. See this area here wasn't followed by a correction until way over here. And that was really a choppy period in 2019. And after September, we know that the Fed started printing money. So the Fed started printing money in the repo market and bailing out whoever they bailed out caused that rally. That was a Fed-induced rally. This is a Fed-induced rally. At what point do the markets demand, right? At what point do the markets demand that reality be honored? I don't know how bad things have to get economically for the stock market to say, oh no, we need to get to the other side of the boat. The only argument to be long right now is, well, it's going up. Hey, great argument. It actually is a pretty good argument. Because who cares why it's going up at a certain level? But if you're going to invest on the long side, you better have very tight trailing stops right now. And if you don't know what a tight trailing stop is, you better look it up. Robinhood users, that millennial group and younger, is loading up on leveraged ETFs. We've also talked about Reddit and how Reddit uses leverage via the options market to pump up certain stocks, Tesla being the classic example. At what point does leverage get difficult to take, right? So instead of using margin, they're using levered ETFs. So that margin number I showed you earlier that says neutral might be wrong. Might be wrong. They're doing it a different way. They're leveraged without taking margin, because that is through the futures market, so it's hidden. So I would suggest that leverage is actually higher than we think based on traditional measures, because the number of leveraged ETFs is pretty huge. What do you think this group is going to do when the market starts to go down? First, they'll sell, right? Because they have that little alert app, time to sell. That's what it does. My son's got it. And then they're going to buy leveraged short ETFs, right? And that'll push it down fast as well. So over the last couple of years, I've told you that, and even in October 2018, I suggested that this market could fall straight through the floor. We saw it happen just a couple of months ago, and people want to put it into their collective mind that, well, it's just because of coronavirus. No, it was because of market structure. Coronavirus was just the match that lit the tinder. So we can see this sort of thing again. It'll be from a lower high most likely, which means we can get a lower low if the economy remains weak, which it probably will. Fear and greed index, not quite super euphoric, but closer to greed than fear. A little bit above neutral. And again, I think that the indicators, because of the market structure, aren't quite giving the warning signals that they normally would give. And the technical traders and the Elliott wave people and the Fibonacci people and everybody else, because all those things operate on scenarios, are placing the wrong probability on the optimistic scenarios and the wrong probability on the less optimistic scenarios. They're all coming to say, oh, maybe we're not going to see as much downside. I'm going to downgrade my theory here. I'm going to create an alternative wave count. I'm going to do this. I'm going to do that. Because I think the market's okay with what's going on. And they do that because they have a system, much like a gambler would have a system, and they put all their faith in their system. What do we know about most gamblers? I want to see at least one person post it. What happens to most gamblers? They lose money, right? A lot of them go broke. Just like a lot of people went broke in 2008 and earlier this year, right? So actually, no, craps is a net negative game for the players too. You just can stand around and look at pretty girls and drink for longer. There are games. I'm very, very acquainted with casinos there, Brandon. There are games where the rules allow you to lose your money slowly, as long as you keep your bets small. And so the mission there becomes to have a better time based on what you lose, right? If I'm going to lose $200 tonight, I need to have at least $201 worth of fun. So that's yeah, right. That's how casinos work. Now, there's a lot of games where the odds are much worse than 51.49. And if you're playing poker, not only is there a rake, but there's guys like me and guys that are better than me who literally scoop 90% of the money. So the house gets 10, everybody else gets 10, and we get 80. So we get 90 of what the house doesn't get. And I'm at the low end of that. I'm not even that good. I'm just a really good amateur. So remember I told you that volume falling off a cliff was bad? Look at yesterday's number. Volume in the stock market was pathetic. I think some of that has to do with the protests. So we'll see where it jumps up to today. Does it get back into this area? But we know that right in this area, we're below right now, but I think that might be an anomaly. I think it'll jump back up. This is the SP 500. Or it might, yeah, this is the SP 500. If this volume stays down here, the market's in imminent trouble. I think it'll jump back up. We'll see. How far can the stock market go down? Long way. Long way. We're at some pretty significant levels here, resistance levels. The odds of it getting all the way back to the high, man, I got to put that at single digits. So it's just very unlikely. But can it go up another few percent to even 10%? Yeah, it could. Right in this area, it could climb this ladder. It certainly could. But I think that the correction that's coming, short of a massive fiscal response that has immediate impact, which really can't happen because of coronavirus, right? Even if the government did all the right things, the problem is people are still dying in record numbers. So, and again, yes, it is the older and the sicker who are dying the most, but healthy younger people are having significant health problems with ongoing effects. About 4 times as many people having significant health problems as there are dying. And that's basically the younger people have the health problems. It doesn't make the news because they didn't die. You can go ahead and Google that. It's out there. So employers have made big changes. The real estate market is changing dramatically. Remember I told you there was a really nice office space, a work-live space. You do kind of what you want with it. Ground floor in a nice neighborhood, downtown Milwaukee. Really one of the best places you could be. And the rent for that was going to be $1,600 a month, plus a parking fee, plus if you wanted to ever have your pet there. So you're looking at about $1,800 a month. My daughter just applied for that place and negotiated a deal where the rent would be $1,400 a month, going up to $1,500 a month over 5 years. So it includes everything. Never going to get to what they were asking, and an $8,400 credit towards rent the first year. So basically, the first year rent is half. Half. And if you're looking in the news, and somebody mentioned it here, there are doctors, lawyers, engineers. I mean, it's everybody out there is asking their landlord for a rent break because they're saying, look, we're not going to make as much money. This is why I really don't like office REITs. Really, I hate them. Commercial REITs in general, outside of strip malls, and industrial, right? Industrial is different. But I think commercial is, office REITs in particular are in big trouble. And mall REITs, so offices and malls, I don't want no part of. This market clearly can retest its low. Does it stop down in this area or this area? Yeah, it might. We'll see how bad the momentum gets. But as it starts breaking through these bigger levels, those 2,000-point drops, I mean, the Armageddon scenario is really pretty low. It's I mean, I don't even look at 180 and 190 on SPY as Armageddon. It can go lower. The Armageddon scenario is way below that, like 1,200 on the SPY. And a couple other people have talked about that. Don't think it's going to happen. Hope it doesn't happen. But it's probably more likely than a bull market. So what trades do we want to make now? Again, trim some stocks and ETFs. I know some of you are stubborn about that because, oh my God, I got to keep my dividend income. Sell stocks that have an at-risk dividend, all of them, and sell covered calls, sell cash secured puts on something else if you want income. At least then you're building a gap between today's price and the down price that it could go to. You can create a 5% dividend income, right, through option premiums if you sell a long enough duration put. So if you're afraid of the stock market dropping 20%, sell a put that's 20% out of the money on your 10 favorite stocks and go far enough out that your time value still captures the dividend. You're creating a margin of safety of 20% there. You might even be able to get 30%. Volatility is high. The premiums are high. Option premium right now is higher than dividend payments. And dividend payments are getting whacked left and right. And they've fought it. They haven't happened all that many yet, right? 70 or 80. You're going to see a whole bunch more dividends get cut in the S&P 500. I would venture a guess that over half of the companies cut their dividends by the end of this year or first quarter next year. Sell long-dated covered calls on stuff that you insist on owning. And I wouldn't sell those two out of the money because we know there's a correction coming. Sell them at the money, put the time value on your side. If the market falls, sell a put as well. But remember to use your technical indicators. Trades to make soon. I think there's a chance to accumulate GDX and GLD soon. Not right now, but soon. Sell all these stocks that we talked about. You don't want to be in anything highly correlated to the S&P 500. Anything that could cut its buyback, you want to be out of. Anything that could cut its dividend, you want to be out of. You want to be out of the banks. You want to be out of the home builders, even though they've gotten beat up. I think they get beat up again. Again, I do think they are major beneficiaries to stimulus, though. Oil stocks, the bankruptcies are just beginning. I think that there's a pretty good argument to sell XOP. The S&P 500 editions that we talked about, remember, it's a double-edged sword that they're going to get S&P 500 money soon, right? If the S&P 500 sells off, they get beat up. So I'm probably waiting for a correction to buy those stocks or sell cash secured puts. So where to build hedges? SPY, IWM, the dividend cutters, the buyback cutters, oil and gas. Focus on liquidity and technicals. Take a look. S&P 500 started way up today, right? RSI off the bottom. Doesn't have to get overbought. What you want to take a look at is, when is the RSI higher than the MFI? Somebody answer why that would matter. Who's been studying RSI and MFI? Right? They share most of their characteristics except the one. That's right, price action and volume. So if the relative strength index is higher than the money flow index, it means that the underlying strength in the market really isn't there. When the MFI is higher, right, because of higher volume than the RSI, you should be pretty confident that it's a good move. So when the market is in this middle area and MFI is 50, and RSI is 55, that should tell you that this is not a very well supported rally. You want MFI to be higher than RSI. That's why overbought on RSI is 70, but overbought on MFI is 80. So anytime MFI is below RSI, you should be concerned. Not a very strong move in the market. The price is going, right? Price is going. But that won't last long without volume. And again, look what's happened to volume. Now, again, I think this is an anomaly. We'll see what it does today. But really, under about that level is negative for the market. And we started to see it happen already late last year. And then you got your 401k money. And then you got the panic. As the panic subsisted, it fell. And what do we know right now? A lot less 401k money going into this market, right? Not only are people out of work, but we're getting the announcements from the employers again that they're cutting the matches. XOP had a good rally off the bottom because of the hopium that there's a new renaissance in oil coming. There's not. Relative strength, 60. MFI, 40. This is what you want to short. This is what you can buy puts on. Go ahead and buy puts on XOP as your next short. Now, you can pick out the companies, but then you better know the companies really well. If you're going to short Occidental, you better know what Carl Icahn is up to. I think that you can pretty safely short the whole basket if you can get decently priced puts. If you can get decently priced puts, it would be right now, right? MACD is doing the jitterbug. It's going to fall over soon. All right, we're going to cut it off there. I'm going to stay on the air with the members and answer a few questions. I will say, if you're jonesing, you gotta get a long position. Sell a $14 put on Kinder Morgan into the autumn. Remember, it's got a 7% dividend, so you got to get a worthwhile premium. But I think that this is one that, because it's natural gas and they're going to get paid, and they already made sure that they didn't raise their dividend too much, I think you can either buy it on the dips or sell the $14 puts. I think AT&T, I think you can buy the dips or sell about $28 puts. Store Capital, I think you can buy the dips or sell about $18 puts. All right, so there are a few things out there that are worthwhile. You have to know what they are. But the broad indexes are extremely dangerous. Anything highly correlated to the S&P 500 is extremely dangerous. That's why I like gold and gold stocks, because we have seen the really low correlation. I've showed that in other charts. So, you know, if we go to our friendly, loyal stock rover, go to the correlation area, and we want to put in the S&P 500, and we want to put in QQQ, and we want to put in GDX, and we want to put in GLD, and we want to put in liquid, which is the investment grade bonds that we just bought. We want to put in the high yield that we just bought. I think that's the right symbol. We want to put in the fallen angels. I don't think there's actually local in there. I don't know if it has it. No, they don't use it. You can see that the correlation of gold stocks, the S&P 500, is way down at 0.15. High yield bonds are more correlated to the stock market than gold stocks. High grade corporate bonds, not as correlated. And they're getting Fed support at that BBB level. So your safest bonds right now are these. And I think there's an opportunity coming in municipal bonds, but maybe not until later this year. This ended up not working. How do you know what that is? So low correlation, low correlation. Most of the gap has been made up in LQD, so there's not a lot of money to be made there. But I think you can sell puts on GDX and GLD very soon. Gotta remember, when there's a broad stock market sell-off, that assets that have value also get sold off. That's why GDX got beat up that one time. It was a rare opportunity for us. So because I'm going to probably have some GDX called away if I don't buy back those calls, which I think I can do because the time value is eroding on a correction. We'll see. But remember, understand correlation. Not very correlated, but high yield debt's very correlated. So, all right, we'll put this one on ice. I'll answer some questions, and then I'll see you Friday after that.